Good afternoon, and thank you so much for joining us for this webinar with guest Jay Scott. He's going to be talking about recession-proof real estate and really sort of going over historically what we see for economic cycles and how it pertains to real estate investing. So it's going to be a really great webinar. I'd like to encourage everybody to make sure if you have questions for Jay, get them typed into the question box. We are going to take questions throughout the webinar, and we always love to have questions, make it really interactive. And don't be afraid to ask questions. We're not going to call you out. I'll simply read the question. Sometimes I'll answer them independently if they're more personal questions, or we'll have Jay address them on the podcast. My name is Larissa Green. I'm with Advanta IRA. For those of you that don't know me, basically what I do for Advanta is marketing, business development, and education. So if you've attended one of our webinars in the past, you've heard my voice, or if you've come to a lunch and learn, you've seen my face. But I've been doing this for about 8.5 years now. I really enjoy it. I meet a lot of really great people when I'm out there networking. And so the next time I'm out and about, if you see me, make sure you come over and introduce yourself. Here is my contact information. So if you have any questions for me on self-directed IRAs, I'm always available. I'm always happy to answer your questions. You can either email me or give me a call. If you're not aware of who Advanta IRA is, what we do specifically is help individuals with qualified funds that want to invest in alternative assets. So what that means to us very specifically is anything outside of the market. And although we talk mostly about real estate, and that's just because that's the most common investment we see, there are other types of alternatives out there that people are using their self-directed accounts to make investments into. And so just a little bit about Advanta. We've been doing this for 17 years now. We do have 2 offices. So we're in Largo, Florida, which is where I'm located. And then we're also in Atlanta, Georgia, but we can help anybody anywhere that wants to self-direct their retirement account. And so what we do that's a little bit different than some of our cohorts is that we really try to make everybody have what we consider a personalized experience. And so what we do in order to really make that work is everybody is assigned an account manager, and that person is with them for the life of the account, meaning they're available to answer your questions, whether it be something from a contribution limit all the way through to any investment that you want to make. And all of our staff is very familiar with investment strategies, anything from simply purchasing a rental all the way through to doing things like non-performing seconds or wrap loans. So again, we're very well versed in this space. And so if you have any questions at all, please feel free to reach out to us. Something that we don't do is give legal, tax, or investment advice, and that's very important to us so that we can remain a neutral third party when you're making investments. So if you come to us and you say, this is the investment I'm making, is it something allowed in the IRA? We can help you understand the rules and how they work. If you ask us, is this a good investment? We really can't answer that, but we certainly could refer you to professionals that our clients have worked with in the past. So just keep that in mind. You're always welcome to ask the question. If it's something I can't answer, I will let you know. I only want to touch very briefly on self-directed IRAs in case there are people listening that just don't know much about what we do. But then I'm going to turn it over to Jay. I want to give Jay plenty of time to cover his topic. So what is a self-directed retirement account? Well, as I already mentioned, it really kind of covers all of those investments outside of the market. And again, we don't sell any investments at all. We just simply provide a service. So the IRS requires that you have some third party hold your IRA. So you can't just go open a bank account, call in an IRA, and make a contribution. You're not going to get your tax credit for that. It's not going to grow tax free or tax deferred. So that's very important. So we act as that third party. But what we do differently than Charles Schwab, Morgan Stanley, Fidelity is that we don't direct you to any investments. We're not selling anything market-based. So it's going to be up to the account holder to find those investments and how they want their account to grow. So that could be something like buy and hold real estate, and that could be long-term rentals, short-term rentals. It could be fixing and flipping. You can lend money from your IRA account. You can be the bank, as we like to say, to somebody else for maybe their rental property or their rehab project. And there's all kinds of other investments unrelated to real estate. We see people invest in cryptocurrencies and gold and silver coins. I have clients that simply invest into private placements or maybe buy private stock. I even have clients that do large equipment leasing, like farm equipment, ATM machines, large format printers. So it's really sort of up to you as the investor and maybe based on what you know best. So, if you like to work on buying small businesses and you've seen a lot of startups and you have knowledge in that space, maybe you want to invest in startup companies, and that's certainly something you can do with a retirement account. And then just very quickly, I just want to go over the types of accounts, because for whatever reason people tend to sort of focus on a Roth IRA. Well, I don't have a Roth IRA, or I don't want a taxable event to convert to a Roth IRA, so I can't self-direct my account. But the truth is, if it ends in IRA, it can be self-directed. And so pretty much any account that you have in existence out there can be self-directed, and that includes old employer plans. So you can see up here, the most common types of accounts are going to be, of course, traditional IRA and Roth IRA, but the lesser known accounts like a simple or a SEP, those can be self-directed as well. And if you're self-employed and you have no employees, you also qualify for an individual 401k, sometimes referred to as a solo K or a one participant plan, but those can be self-directed. And then the other two accounts that may surprise you that I have up here are ESAs, or education savings accounts, and then health savings accounts. And we can help you with those because the rules for self-directing them are exactly the same. And so you can certainly open and hold those two types of accounts with Advanta as well. If you have any questions on the types of accounts, please let me know. And then just one note, one thing I want to point out, especially because we're getting so close to the end of the year, if you're considering a solo 401k, you just have to have it open by 12/31 in order to contribute for 2019. So you do have a little bit of a deadline. Typically, we get a little bit of leeway on our tax deadlines, but this is one that they don't give us any leeway on. So if you're thinking about a solo 401k, either reach out to me or somebody in my office and make sure that you find out whether or not you would qualify, and then go ahead and get that account open by 12/31. So with that, I want to introduce Jay. Many people on the webinar will know Jay. He does a webinar with Bigger Pockets. He has written some books, and I'm going to let him really kind of introduce himself. But how are you doing today, Jay?
I am doing great. I'm excited to be here.
Thank you so much for joining us for this, and I know we're going to have a lot of questions as we go.
Excellent. Thank you so much, Larissa. And hi there, everybody. I am thrilled to be here. Let me give you a little bit of background about who I am, just so you know who you're listening to. So my name is Jay Scott, and let me start with who I'm not. I am not a professional speaker. I don't do this professionally. I am an investor, like many of you are or want to be. So that is first and foremost my background. So if this doesn't sound like a professional talk, I apologize. But that's who I am. So I come from a corporate and business background. I spent much of my career running businesses for Microsoft. Back in 2008, I left the corporate world. My wife and I started investing in real estate. And over the last 12 years, we have been investing in basically all aspects of real estate, from flipping, rentals, notes. We've done lending, we've done ground up development, multifamily, a little bit of everything. In that time, I've written 4 books for Bigger Pockets. You can see them there. I'm not here to sell books, but if you have any questions, I'm happy to answer them. And my wife and I are currently co-hosts of a podcast for Bigger Pockets called the Bigger Pockets Business Podcast. So if anybody out there is interested in learning more about entrepreneurship or running businesses or growing businesses, please, I'd love for you to tune into our podcast. We're very proud of it. Okay, so today I am going to be talking about the economy. And I'm going to be talking about the economy and how it impacts us as real estate investors, and how we as real estate investors, and actually I'm going to touch on other types of investing, how we as investors in general can use the information we can glean about the economy to continue to maximize our profits, continue to minimize our risk as the economy changes. So the agenda for today, and let me start with a couple disclaimers, because these are important. And I know I'll get some questions if I don't say this, so let me throw out a couple things. First, I can't tell you when the next recession is going to hit. I don't believe anybody can tell you when the next recession will hit. along with that, I can't tell you how bad the next recession is going to be. I don't know. I don't believe anybody knows. If somebody tells you that they know when the next recession is coming or how bad it's going to be, my guess is they're probably trying to sell you something. So take it with a grain of salt if anybody tells you that. The best economists in the world don't know exactly when the recession is going to hit or the next recession is going to hit. The best economists in the world don't know how bad or not bad it's going to be. So if somebody who's not an economist tells you that they can tell you that, they're probably lying to you, or maybe they're just lying to themselves. Okay, so those are the first two disclaimers. The next thing is you're going to hear a lot of people tell you, based on what's going on in the economy, this time's different. And this time things are going to happen differently than the last 33 times that we've had economic cycles that I'm going to talk about today. And who knows, they might be right. This time might be different. There might be some fundamental differences in the economy today than there has been for the last 200 years in this country, but probably not. I'm a big believer that history is the best predictor of the future, and that looking back at things that have happened in the past is the best indication of what's likely to happen the next time around and the time after that. I'm not telling you that this time might not be different, but a lot of people are saying it. Maybe it is, but statistically speaking and historically speaking, this time is probably no different than the last, again, 33 times. So what I'm going to talk about today is a little bit of history when it comes to the economy and economic cycles. And I personally believe that this time around will be somewhat similar. So we can probably follow the trends that we've seen in the past to extrapolate what's going to happen in the near and the further future. Okay, in terms of agenda for today, first we're going to talk about why this topic is important. Why do we care about the economy? Why do we care about how economic cycles work? Then we're going to talk about what an economic cycle is. I'm going to talk about a little bit where I think we are in the cycle and why I believe that. And again, this is all going to be based on data. This isn't so much my opinion, and I look towards you to take the information that I'm going to provide and basically make your own decisions, because everybody can look at data and interpret the data differently. I'm going to interpret the data the way I do. I'm going to tell you why I interpret it that way, but I want you to look at the data as well with me and make your own interpretations, and maybe there'll be an opportunity to talk about it after this webinar with through some questions. Okay, and then finally I want to talk a little bit about what we as investors, real estate investors, and even outside real estate investors should be doing now based on what I see the economy doing and based on what you may see the economy doing after today's discussion. Okay, so let's start with why understanding economic cycles is important, especially as real estate investors. First and foremost, the economy affects real estate, even if real estate isn't driving the economy. What do I mean by that? Any of us that were here during 2008 probably remembers that the 2008 recession was, for the most part, driven by real estate forces, was driven by cracks in the real estate market, cracks in the lending market, cracks in the mortgage market. 2008 was very much a real estate recession. But historically, real estate is not the cause of recessions. Historically, other things cause recessions. Sometimes it's nothing specific, but in many cases it is. Go back to 2001, the recession was caused by a combination of the internet boom and the internet bubble, along with 9/11. Go back to the late 90s, we had the savings and loan crisis. Go back to the early 70s, we had the oil crisis. Go back even further to the 1930s, and we had things like deregulation and tariffs that caused major economic turmoil. Every recession, every economic cycle is driven by different things. And if you only think about 2008, you probably assume that real estate is kind of the driver of that economy. But in reality, real estate rarely is the thing that causes the economy to go up or go down. Now, along with that, real estate is typically what's called a lagging indicator, which means that typically whatever happens in the broader economy is going to happen before it happens in real estate. If the broader economy goes up, real estate's going to follow, typically 2, 3, 4 months later, so about a quarter later. If the broader economy starts to drop, to go down, if we head into a recession, typically real estate's going to head downward in 2, 3, 4 quarters later. Again, about a quarter later. So while we think of real estate as a lot of us like to look at real estate and say, hey, our market's really strong, therefore the economy's strong, or our real estate market's getting weaker, therefore the economy is getting weaker. It's actually the other way around. Typically, it's the economy that's going to move first, and real estate's going to move in a similar pattern, but a few months later. Now, why is this important? Because understanding these cycles, how they work, being able to look at the indicators and to some degree predict what's going to happen is going to allow us as investors to maximize our profits and also to minimize our headaches and most importantly, to minimize our risks. Okay, so that's why this topic is important and is especially important to us as investors and real estate investors. Now, let's jump into what an economic cycle is. A lot of you might know this, but I always think it's important to start with the basics because I don't want anybody to kind of be catching up. So what's an economic cycle? Typically, we think of an economic cycle as the economy going up and down in a cyclical fashion or cyclical pattern. So the up part of an economic cycle is called the expansion. And this is where typically things are going well, businesses are making lots of money, wages are growing, employees are happy, unemployment is dropping, people have a lot of money to spend on consumables and luxury goods, and everything is good. Then we get to the top of the market and things start to move the other direction. We have a downturn, or what's often called a contraction. Sometimes we call it a recession, sometimes we call it a depression, depending on how bad it is. But in general, it's a contraction. People are losing their jobs, businesses aren't performing as well, they're not making as much investment into the economy, wages are dropping, unemployment's going up. Basically, things just aren't that good in the economy. Eventually, we get to a bottom, and that bottom, we see a turnaround and we start the next expansion. Typically, we call this a recovery, but that's the next expansion. This is a typical pattern that we've seen many, many times over the past 200 years in this country, and every country that has what would be considered a mature economy sees this pattern over and over again. When you put the cycles back to back, we see a pattern that looks something like this. Now, it's never really this clean. This is kind of what we see in textbooks, but in reality, what the economy looks like over many, many decades is something like this. The most common measure of economic performance in the United States is what's called GDP, or gross domestic product. And that's a measure of the total output of the US economy over a given period of time. And typically we use GDP to define how strong our economy is. When GDP is growing, we talk about that being an expansion. When GDP is negative or contracting, we talk about that being in the contraction or the recession. So this is kind of what that cycle looks like over many cycles. As you can see, it's not uniform. The length of the cycles aren't uniform. The height or the how bad the recession is or how good the expansion is not uniform. Things tend to happen in an ugly sort of fashion, but you see trends here and you can see the up and down fashion over the last several decades. Okay, so that's what an economic cycle is. Now, let's talk about, because everybody really wants to know, where are we in the economic cycle right now? And that's kind of the big question. And I know there's a lot of argument over where we might be in the cycle right now. Some people think that we still have a long way to go up. Some people think that we're at the top. Some people think we're actually on the way down. So let's talk about how we can determine where we might be in the cycle right now and what indicators both economists and I guess armchair economists look at to determine where we might be. Now, I like to look at, and when I say I'm not an economist. I have a business background, I have an economics background, but I'm not an economist. I rely on what other people say. I look at the data, I read the articles, and this is how many economists out there are currently looking at the economy and economic cycles. They look for three things. First, they look at timing. Second, they look at observation. And third, they look at the actual hard data. So I'm going to go through each of these three things and talk about what we're seeing today in terms of the economy and how we might best judge where we might be in the economic cycle. So let's start with timing. So timing is basically this idea that things happen in regular patterns. So the economy happens in regular patterns. We talked about there being a cycle, this constant up and down. Over the past 70 or so years, this is what our economies look like. And in that time period, we've seen a number of recessions. These gray bars are recessions. By definition, the government says if we see negative GDP growth for 2 quarters in a row, by definition, that's a recession. So this is where the government has defined, based on that definition, that we've seen recessions over the past 70 years, those gray bars, those red arrows. Okay, we can smooth out this curve a little bit. We see something that looks closer to those economic cycles that we were talking about. And if we measure the number of economic recessions we've had over the past 70 years, we get 11. There are 11 times over the past 70 years that we've gone into recession. So that's about 11 cycles over the past 70 years. If you do the simple math, you divide 11 into 70, you'll see that on average, we go through an entire economic cycle in about 6.5 years, which means we go through that expansion phase, we go through the contraction or the downturn, and then we go back into the recovery and start the expansion again. Over the last 70 years, that's happened 11 times, or on average, about once every 6.5 years. Now, I know a lot of people, when they hear this, they're very surprised because, again, a lot of us weren't really paying attention to the economy until about 2008. Here we are 11 years later, 12 years later by some accounts, and we're still in the midst of the same cycle. So a lot of people tend to believe, especially those that haven't been investing for a long period of time, tend to believe that this cycle is much longer than it typically is. Again, historically about 6.5 years. And in fact, if you go back further, if you go back 33, the last 33 cycles, what we've seen is the average cycle is actually closer to 5 years. But recent history, expansions and contractions have tend to be a little bit longer. The total cycle has expanded a little bit over the last 70 years. So 6.5 is probably a better average. But this is a picture of the last 33 cycles. The blue is the recessions, the red is the expansions. But these are the last 33 cycles and how long they've lasted. Here is our average. It's somewhere around 6.5 years. And here we are today. Today we are in the longest cycle in history. This is the longest expansion in history. The recession back in 2008 was actually about average, but the expansion that we've experienced since around 2009 has been the longest expansion in history. So just going by timing, just looking at what historically has been the average cycle length, again, about 6.5 years, today, we're about 11 years into the current economic cycle. From a timing standpoint, that tells us that we're probably closer to the end of the cycle than we are to the beginning or we are to the middle. Now, timing doesn't tell us everything. It doesn't tell us if we're 2 months from the recession or we're 6 months from the recession or we're 2 years from the recession. But what it is telling us here is that, likely speaking, we're probably closer to the end of this expansion than we are to the beginning. Okay, so that's just your first data point. That is timing. The next piece we like to talk about is observation. Observation is the least quantifiable aspect of interpreting where we might be in the economic cycle. And observation is really just about looking around and trying to figure out, based on consumer sentiment, based on everything from optimism to how people are spending money to how people are investing money, what does it feel like the current market is giving us? So we think back to 2007, any of us that were investing in real estate back in 2005, 6, 7, we remember what Alan Greenspan affectionately referred to as irrational exuberance, people throwing money into real estate without much thought or research. We saw the same thing back around 1999, about 2000, with the tech industry, with the internet boom, people just throwing money into the real estate. I'm sorry, into the internet, into the stock market around internet stocks. There was this irrational exuberance, and there was just this feeling that we were at the critical point in the cycle where things were about to hit a tipping point. Now, again, observation, not very quantifiable, but there is one area of observation that can be quantified. University of Michigan does what's called a consumer sentiment poll. They do it every quarter. Actually, they do it every month, but I think they aggregate it by quarter. And over the past 50 or so years, this is what consumer sentiment has looked like. And again, it's very cyclical. We tend to see consumer sentiment drop just before a recession and then go up right after a recession. It tends to stay steady. Maybe it goes up a little bit and then it drops again before the next recession. So this is another good indication. What we've seen is that over the last year or two, consumer sentiment has been pretty consistent. We've been pretty much in the same place with consumer sentiment for the last 3 or 4 years. Again, just a good indication of where we might be in the cycle. Okay, and we'll go back and we'll look at the consumer sentiment data a little bit more later. But that's the observation piece. Finally, we get to the most quantifiable aspect of where we might be in the cycle, and that's economic data. Now, when we talk about economic data, we're talking about one or many of thousands of data points that indicate what's going on in our economy right now. Now, when I look at the economy and I look at economic data, I like to think about this as a puzzle. If I were to hand you 1 or 2 or 5 puzzle pieces, you're not going to have a really good idea of what the picture on that puzzle is. But as I continue to give you more puzzle pieces, as you continue building that puzzle, a picture is going to emerge. And if it's a 1,000-piece puzzle, by the time you have 600 or 700 or 800 pieces, you're going to get a good idea of what you're looking at. It's the same way with the economy and economic data. I can give you 1 or 2 or 3 pieces of economic data, and that might give you a very, very broad and unreliable viewpoint of what's going on in the economy. But as you look at more and more and more and more data points, a picture starts to emerge. So those who look at the most economic data typically have the best view of what's going on in the economy. And it's typically a lot more complicated than somebody who's looking at 1 or 2 or 3 pieces of data and then trying to convince you that what they believe is correct. So I'm going to give you a few of the most common pieces of economic data that economists, that scholars, that the Federal Reserve Board looks at to try and discern where we might be in the economic cycle. But I will also caution you that even these 9 or 10 or 11 pieces of data that I'm going to give you today probably isn't enough to form a true picture of where the economy is right now. But this will give you an idea of what you can be looking for, what you can be looking at, and a starting point for how you can start aggregating the data that you think is important and kind of form your own puzzle. But let's look at some of the pieces of data that are commonly looked at to discern where we might be in the economic cycle. First is something called yield curve. I'm going to talk about that in more detail in just a second. The next thing is that's commonly looked at is something called the Buffett Indicator. And I'm going to talk about that as well, but that's basically an indication of whether the stock market might be overvalued or undervalued or appropriately valued. Next, we have gross domestic product. I talked about that. That is the total output of the US economy over any given quarter. And typically when we see negative growth or contraction over 2 quarters, that's by definition a recession. So that's another indicator that we tend to look at on a monthly or quarterly basis. Business investment. Business investment is huge. So typically speaking, one of the best indicators of where the economy is headed is what businesses are doing in terms of their investment, in terms of their expansion. When businesses are spending a lot of money, that's a great indicator, leading indicator that the economy is going to do well over the next several quarters. When businesses stop spending money, that's a great indicator that the economy is likely to be moving in the other direction. Part of it isn't just that it's an indicator, it's actually contributing to it. When businesses stop spending money, it's going to hurt the economy. Just like when consumers stop spending money, it hurts the economy. So business investment is a great, not just indicator, but a great definer of where the economy is likely heading. Next, unemployment. Most of us are probably familiar with unemployment numbers, and that's tends to be a lagging indicator, which means unemployment numbers tend to move after the economy as a whole moves, but also a very important indicator to look at because it gives us an indication of what's happening with consumers. If people are employed, they're making money, they can spend money, they can keep spurring the economy. When consumers start losing their jobs, they have less money to spend, they have credit issues, they can't spend as much money, and that hurts the economy. Next, we often look at housing starts. By housing starts, I just mean the number of permits that are being given out to housing developers, to real estate developers to start building new housing. So real estate developers historically aren't the best judges of where the economy is going, but when real estate developers start to see cracks in the economy, they slow down their building. Remember, when you build a house, it can take 6, 12, 18 months before that's going to be sold. So if a developer sees that they believe the economy is going to start a downturn in 6 or 12 months, they're not going to start as many projects. Foreclosure rate is a good indicator of where the real estate market is headed. To some degree is also a good indicator of where the economy as a whole is headed because it indicates what kind of problems consumers are having in terms of being able to make their mortgage payments. Next, the stock market, another typically lagging indicator, meaning the stock market tends to move after the economy moves, but it's still an indicator of consumer sentiment. And it goes back to this observation piece that we were talking about. And a lot of people will look at the stock market. If they see the stock market going up, they're going to be more confident. They're going to be willing to spend more money. And when people spend money, the economy tends to do better. So stock market, while it may not be a great indicator, it's a great indicator of at least consumer sentiment and feeds into the observational piece and can actually influence what people do today and tomorrow. And then finally, we've talked about consumer sentiment a little bit. Okay, so I want to talk a little bit about the first economic data point that I have on this list, and that's the yield curve. Now, the reason I like to talk about the yield curve is because around this time in the cycle, we get a lot of people that start throwing around this word yield curve. And I'm sure if you've been paying attention, if you've been on Facebook, if you've been reading the news over the last 3, 6 months, you probably heard the term yield curve over and over and over again. A lot of people will talk about inverted yield curves or flattening yield curves and things like that, but they don't really understand what they're talking about. And I find that it's a really interesting topic because it's probably the best indicator. The yield curve is probably the best indicator historically of where the economy is heading. Historically, it's been incredibly successfully predictive in terms of what's going to happen 6 to 12 months out. So I just wanted to take a minute. I wanted to talk a little bit more about the yield curve. Some of you might find this a little bit boring, but let me tell you something. If you can follow along here, you're going to be a lot more fun at parties when people want to talk about the economy. And that was a joke. None of us really like talking about the yield curve at parties. Okay, sorry, I had to take a quick drink. Okay, so what do we need to know to understand the yield curve? First, we need to understand that the government raises money. They raise money a couple ways. One, they charge taxes, but a second way that they raise money is that they sell bonds. And bonds are basically loans that the government takes to raise money. So we as individuals or large investors or companies or even governments can buy government bonds. And basically the government takes that money and they pay interest on that money. Okay, so government raises money by issuing bonds, which is basically just loans from people like us, and they pay interest on those bonds. The second thing to understand is that each of these bonds has a maturity or an expiration date. So there are things you'll hear 1-month bonds and 2-month bonds and 3-month bonds. And basically that's just how long we're loaning the government money for. So if I buy a 1-month bond from the government, basically I'm giving my money to the government for 1 month. They're going to pay me some interest on that money for 1 month. And then after a month, they're going to buy that bond back. So it's basically every one of these bonds has a length of time, an expiration date or a maturity date for how long we're loaning the government money. Typically speaking, the longer we're willing to loan the government money, the more they're willing to pay us in interest. So if we buy a 1-month bond, typically the government's going to be willing to pay us less interest than if we buy a 6-month bond or a 1-year bond or a 5-year bond or a 20-year bond. If we're willing to loan the government money for 20 years, they're more likely to pay us a higher interest rate, or when it comes to bonds, we often talk about yields instead of interest rate, but yield and interest are essentially the same thing. Um, if we're willing to lend the government money for 20 years, they're willing to give us interest or yield that's higher than if we were just willing to lend the government money for a month or 2 months or 3 months. So typically, the longer the maturity, the longer the expiration date, the more interest the government is willing to pay. Now, let's look at what bonds were paying. Let's look at the interest or the yield that bonds were paying. I picked back January 2004 as my example here. Back in January 2004, if you were to go out and buy a 3-month government bond, the government was willing to pay you about 1% annualized interest on that bond. Now remember, if you're willing to loan the government money for a longer period of time, they're willing to pay you more interest. So if you're at the same time, if you were willing to get a 2-month government bond, the government was willing to pay you about 2% interest. Now, let's say you were willing back in January of 2004 to buy a 5-year bond. If you were willing to buy a 5-year bond from the government, basically loan the government money for 5 years, you could get about 3.5% interest or yield. 7-year, about 4%. If you were 10-year, about 4.5%. And if you were willing to loan the government money for 20 years back in 2004, basically you'd still be holding that bond, they'd still be holding your money right now. The government was willing to pay you about 5.5% in yield or interest. Now, this is what we refer to as a yield curve. This was the yield curve from some day, I think this was January 1st, 2004. And what you see is that this curve tends to move from the lower left to the upper right. And this is what we expect. Remember, the longer you're willing to loan the government money, the more they're willing to pay you in interest. But here's the kicker. It's not the government that's deciding how much to pay you in interest. This is actually a market. And just like any market, it's controlled by supply and demand. And basically what the market says is the shorter period of time that you're willing to hold the bond, the less interest you're going to get. The longer period of time you're willing to hold the bond, the more interest you're going to get. That's standard market forces. Now, because it's market forces, as supply and demand go up, the interest rates are going to go up and down. I'm sorry, as supply and demand goes up and down, interest rates are going to go up and down. Specifically, if there's demand for a certain one of these bonds, if more people say, I want a 5-year bond right now, that means that the government doesn't have to work as hard to sell those 5-year bonds, and the interest rate's going to drop. So if a lot of people want 5-year bonds right now, there's a high demand, the interest rate on 5-year bonds is going to go down. Likewise, if there's no demand, if nobody wants a 5-year bond, the government's going to have to pay, or the market's going to have to pay a whole lot higher rate to encourage people to buy those 5-year bonds. So if demand goes down, interest rates go up. Okay, so that's what you have to understand here, is that the yield curve or yields on these bonds is driven by market forces. So this was January 2004. Let's talk about what happens when investors start to get scared. What we're looking at, this red arrow, this is a normal yield curve. This is what we like to see. But when investors start to get scared, when investors start to think that the economy is getting ready to turn or there are issues with the economy, 2 things happen. First, investors want to move their money to someplace safe. They want to move their money to someplace where they can lock in a fixed interest rate for as long a period of time as possible. Where can they do that? They can do that by those long-term government bonds. So like the 20-year bond is a great place when investors get scared, when they're scared to put their money in real estate, when they're scared to put their money in the stock market, investors start putting their money in places like the 20-year government bond where they can lock in as high an interest rate as possible for a long period of time. But what happens when all these investors, and when I talk about investors buying government bonds, I'm talking about big hedge funds, I'm even talking about governments that are putting in billions of dollars into these bonds. What happens when everybody starts fleeing to these long-term government bonds? There's a high demand for these long-term bonds, and when there's a high demand for them, rates are going to drop. At the same time, when investors are getting scared, they want to start taking their money out of the short-term bonds. They want to lock in longer-term rates. So investors start moving money out of the 3-month and the 2-year bonds. So what happens when demand goes away for those short-term bonds? Well, like we saw earlier, when demand goes away, the rates go up. So when investors start to get scared, what we see is exactly what we saw around March of 2006 before the Great Recession. We started to see a flattening of this yield curve. Basically, the short-term rates were going up, the long-term rates were going down, and this curve, instead of going from the lower left to the upper right, this curve was mostly flat. And we call this a flattening of the yield curve, and this is typically an indicator that investors are getting worried. And remember, these are investors investing millions, tens of millions, hundreds of millions, billions of dollars. So when they start to get scared and when they start to invest their money differently, not only is it an indication of what's going on in the economy, but they're actually impacting the economy as well. So this flattened yield curve, this was March 2006. In August 2006, just a few months later, we saw this exacerbated even more. We saw that the short-term yields, less demand, were being driven up. The long-term yields, less demand, were driven up. And we started to see what's called a yield curve inversion, where the two extremes of the yield curve were higher than the middle of the yield curve. Historically speaking, and there's a lot of reasons why the middle of the yield curve goes down when things start to get really scary, and I'm not going to go into that right now. But long story short, when we see this inversion of the yield curve, when we see this U shape or this inverted shape of the yield curve, this historically has been the absolute best predictor of an impending recession. All but twice since 1957, I believe it was, all but twice since 1957, whenever we've seen an inverted yield curve, we've seen a recession within 12 to 14 months. So given that we saw this inverted yield curve back in August 2006, you would have assumed that a lot of people would have been worried about what was going to happen within a year, year and a half later. Turns out that most people weren't really concerned, except for economists. A lot of economists noted this back in August of 2006 and said, hey, this is going to be an issue. But the general public didn't really know what the yield curve was. A lot of pundits didn't know what the yield curve was, and nobody was really paying attention. But then in February of 2008, we all remember, or actually it was a little bit earlier, I think it was December of 2007, we started to see the real cracks in the economy. So yield curve did a really good job of predicting what was going to happen in 2008, just like it had done a great job back in 2001, back in the late 80s, back in the mid 70s, back in the early 60s. So the yield curve historically has been the absolute best predictor of what's going on in the economy. Now, what have we seen from the yield curve recently? About 2 years ago, we saw a perfectly normal yield curve. Back in March of this year, we saw very much a flattening of the yield curve. And then September of this year, just a couple months ago, we saw the first inversion of the yield curve that we had seen since back in 2006. Now, we've talked about the fact that maybe this time is different. Maybe this time the yield curve inversion doesn't really mean what it's meant in the past. But if you believe history is a good predictor of the future, the fact that we saw the inverted yield curve back in September 2019 is a good indicator that we may be heading towards a recession sometime in the next 14 months. Okay? Now, again, maybe this time is different, maybe it's not, but it's a fantastic data point historically. Okay, let's talk about these data points that I pointed out earlier, and let's look at what they're indicating right now. And maybe we can start to get a little bit of a picture of where we might be in the current economic cycle. So we talked about the yield curve. The yield curve was inverted just about 2 months ago. We haven't talked about the Buffett indicator yet, but I want to give a quick overview of the Buffett indicator because historically this has been probably the second best indicator of where the economy is headed. So Warren Buffett didn't invent this, but he's a big believer in this. And that's basically this idea that the value of the stock market is directly, or the correct value of the stock market is directly correlated to our GDP, our gross domestic product. And if you divide the total GDP, the total output of the economy, by the total value of all the equities in the stock market, you should get a ratio that's somewhere around 0.9 or about 90%. So gross domestic product at any given point in time should be about 90% of the total value of all the equities combined, all the stocks combined in the stock market. Okay? Historically, what we've seen is that's what we refer to as the mean value of the stock market. Typically speaking, if the value of the stock market gets well above GDP, we tend to think that the stock market's overvalued. If the stock market value tends to fall well below GDP, well below that 90% average ratio, we tend to think of the stock market as being undervalued. If we see that the stock market is generally about 90% of GDP, we say that the stock market is probably about correctly valued. Today, we're seeing that Buffett indicator, that ratio, is about 144%, or what some would say is that the stock market is overvalued probably by about 60%. Historically, this has been a great indicator. Historically, the stock market has what we refer to as reverted to the mean or dropped back or gone up to kind of meet that 90% ratio. If it happens this time, then the correct value for the stock market is probably somewhere around 20,000. So, and today we're at about $28,000. So if you look at the Buffett indicator and you believe the Buffett indicator, you're probably thinking that the stock market is a good bit overvalued right now. Next, we have gross domestic product. Over the last several quarters, we saw gross domestic product drop. So back in 2018, beginning of 2018, the government passed some massive tax cuts, and we saw gross domestic product move up to about 3.5% in the first quarter after the tax cuts. Since then, it's dropped to about 1.9% last quarter. While the drop in gross domestic product is somewhat concerning, it's a negative trend. 1.9 or 2.0% GDP growth is about average over the last 10 years. It's actually about average over the last 60 years. So 2% GDP growth is pretty much telling us that the economy is pretty healthy right now. The negative trend isn't good, but the actual number isn't bad. In terms of business investment, this is probably one of the most concerning things we've seen over the last 2 quarters. Business investment dropped tremendously in Q3. Businesses were investing heavily back in 2018 after the tax cuts. They were actually doing a lot of stock buybacks and into 2019. But over Q2 and Q3 of this year, business investment has been down considerably. And business investment, like I said earlier, is one of the best indicators of where the market is headed. Unemployment numbers, 3.7%. Unemployment is historically low. It's a great indicator that people have jobs, people are making money. Now, it's not necessarily an indicator of how much wages are growing, how much money they're making, but they're looking for jobs, they're finding them, they're employed. That's a great indicator for the economy. Housing starts are actually up and down. If you look at 2018, 2 quarters were up heavily, 2 quarters were down heavily. If you look at 2019, we started out the year really rough. A lot of people looked at housing starts back at the beginning of 2019 and said, we're really having a problem here because developers weren't starting development of new housing. Over the summer, that changed. A lot of new housing started to come online over the summer. A lot of new permits were applied for. So housing starts have seen kind of a mixed review over the last year and a half. Foreclosure rate is slightly up. We've seen about a 3% rise in foreclosure rate over the last couple months. That's somewhat concerning, but it's not a huge jump just yet, but something to look at. Stock market is up, obviously. Most of us probably follow the stock market. We've hit stock market highs over the last few weeks, dropped off a little bit, but we're still at 28,000 in the stock market, which is considerably higher than it was just 2 years ago. And then consumer sentiment has been up and down. It's actually been down the past 2 months. This, I think it was up in November, so this needs to be updated, but we're down over the last year or so. So what does this mean? If we look at all of these things, it's very much a mixed bag. There are several things on here that indicate that the economy might be heading in the wrong direction. There are a couple things on here that indicate the economy is still tremendously strong. There are a couple things on here that are more neutral. So if I had to guess where I think we are in the current economic cycle, basically what I would say is I think we're right about here. And a lot of economists are saying that they think that we're right about here. We've probably ended the most current economic expansion. We're probably not going to see a ton more growth in terms of GDP. We're probably not going to see a ton more growth in terms of business investment or housing, but we're sticking around the top. A lot of economists think that we've been around the top for maybe 6 to 12 months right now. We could stick around the top for another 2 months, 6 months, 12 months. We could stick here for another year or two or three. Nobody really knows. In fact, we're not even certain we're at the top. But most economists would agree, and based on the data that we've seen, we're probably somewhere around the top of the market, and we may stay here for, who knows, again, maybe a couple more months or another year. Okay, so that is our best guess of where we might be in the cycle. You're certainly going to find people who disagree with me on that and disagree with economists on that. Maybe they're right, maybe they're wrong, maybe I'm right, maybe I'm wrong. Again, I'm going to go back to nobody can predict exactly when the recession is going to occur. Okay, so what are the wild cards? What are the things that are likely to push us into recession or keep us from recession? Right now, it's generally agreed upon that there are three things that are driving where we might be in the economic cycle right now. Number one, interest rates. So as the government lowers interest rates, that has an effect on the economy. Lowering interest rates means you make less money if you put money in a bank account because your interest that you're earning on that bank account is less. So people are discouraged from putting money into a savings account. Second, when you lower interest rates, people can take out loans for lower interest so they can borrow more money. So lowering interest rates, when the government lowers interest rates, it has two effects. It discourages people from saving and it encourages people to borrow and spend. So lowering interest rates typically means there's going to be more money into the economy and the economy is going to grow. So the lowering of interest rates over the last year or two has really driven some growth in the economy. If the government continues to lower interest rates, we're at about 1.5% now, so they probably have about 6 more drops before they're down to 0% interest rates. If the government continues to lower interest rates over the next quarter or two or three, we'll probably see the economy remain where it is. If the government stops lowering interest rates, who knows what might happen. Second, the Fed has started printing money over the last couple of months. We've injected about $210 billion into the economy over the last couple months. Anytime you print money, you're going to be spurring the economy. You're going to be driving inflation as well because your current dollars are going to be worth a little bit less, but you're going to be spurring growth in the economy. So the question is, will the government continue printing money? Will the Fed continue printing money, or will they slow down? And then third is obviously the trade war. The trade war's had some impact both from the standpoint of consumer sentiment, from the standpoint of basically certain goods being sold. So farmers have taken a hit from the trade war. And so depending on what happens in the trade war, that could impact if and when, not if, but when the economy turns and we head into recession. Finally, let's talk about how we as investors can take advantage of the information that we just talked about and what we should be doing today to be ensuring that that we're able still to maximize our profits, but at the same time minimize any risk we have should the market turn. Let's see. If we're real estate investors, first and foremost, I want you to know that real estate investing still works. Flipping houses still works. Buy and hold still works. Notes still work. Multifamily, everything still works. That said, you do want to take some precautions. You do want to be a little bit more conservative. For example, I've done a lot of house flips. I still do a lot of house flips. My general view on house flipping right now is I'm focused on much shorter projects. I'm comfortable that over the next month or two, the market's not going to drop out from under us. I'm not as comfortable that in the next 6 or 9 or 12 months, it's not going to happen. So I'm focused on doing flips that are much shorter. I'm focused on the 1, 2, 3 month flips. I'm not focused on the ground up development or the big complex rehabs that might take me 6 or 9 or 12 months. Second, I'm focused on areas that tend to have held up pretty well back in 2008. I'm a big believer that what happened in the past is a good indicator of what's likely to happen in the future. If you were in a market that got hit really, really hard in 2008, there's probably a reason for that. There's probably either some systemic reason, there's some reason based on the type of employment in that market, how strongly the market relies on tourism, something. There's probably something in that market that means that market responds differently to a recession than other markets. So if you're in a market that got hit really hard in 2008, that's a good indicator that the next recession is likely to hit your area harder than in an area that didn't get hit as hard in 2008. So for the most part, I'm focusing my flips on those areas that didn't get hit as hard in 2008 as certain other areas. So for example, I'm doing a lot of flipping in Maryland and Washington, D.C., which are two markets that didn't get hit too hard in 2008. I'm staying away from flipping in Atlanta, Georgia, where I was doing a whole lot of flips in 2009, 10, and 11, because that area got hit extremely hard in 2007 and 8, and I don't believe the market dynamics have changed considerably in that area. So take a look at what happened in your market back in 2008. That should give you a good idea of what the risk is moving forward. And again, I'm not saying that I expect that the next recession is going to be anything like 2008, but it's a good indicator of whether your market is likely to get hit more or less than the average across the country. Next, if you're a buy and hold investor, don't stop buying and holding. Buying and holding is a fantastic strategy in any part of the economy. But I will say that you should underwrite your deals a little bit more conservatively. For example, for my buy and hold deals, I'm assuming worst case, I'm going to see about a 10% drop in occupancy during the next recession. Back in 2008, some of the hardest hit places saw about a 10% drop in occupancy. A lot of places didn't see any drop in occupancy. Some even saw an increase in occupancy. But the worst case scenario back in 2008 for some markets was about a 10% drop in occupancy. So to be completely conservative, I like to model 10% drop in occupancy for anything I'm buying now. Likewise, worst case back in 2008 in most markets was about a 10% drop in market rents. To be conservative right now, all the modeling I'm doing when I underwrite buy and hold deals is I'm assuming a 10% drop in rents. If I can model a property and using 10% lower market rents, 10% lower occupancy, the numbers still work for me, I'm all in on that property. I'm still moving forward with my buy and holds. I'm just being more conservative in my underwriting. I would say anybody that's doing commercial deals, look for recession-resistant asset classes. Or if you're doing multifamily, typically C-class properties, mobile homes tend to be a lot more recession-resistant than A-class and B-class properties. If you're doing commercial, self-storage is very recession-resistant. If you buy retail, retail real estate, grocery-anchored retail centers tend to be a lot more recession proof. If you're looking to buy a business, medical businesses tend to be very recession proof. Alcohol and gambling related businesses tend to be pretty recession proof. So there are a lot of things we can do to modify our strategies without giving up on buying businesses or buying real estate. If you're in the equities market, so if you're buying stocks and bonds, my recommendation is to diversify and make sure that you have some recession-resistant asset classes or asset classes that are negatively correlated to the broader market. So that way, if the market starts to drop, you have a little bit of buffer built in. And if you have a lot of loans out right now, I would suggest extending the maturity of those loans. If you have any loans that are likely to come due in the next year or two, it's not a bad idea to go sit down with your lender and say, hey, can we extend the expiration of this loan? Or can I refinance? Because in the middle of a recession is not a great time to be refinancing. A lot of banks tighten up on their financing and refinancing criteria, and it's better to have those terms extended past whatever date you think the recession might extend into now, so that you don't have to worry about that in the midst of a recession. Okay, so that is everything. If you want to find out more, if you're a real estate investor and you want to find out more, including a lot more discussion about what strategies and tactics are working and not working in every part of the economic cycle, I do have a book out there that I released recently. It's called Recession Proof Real Estate Investing. It's on Amazon and it's on the biggerpockets.com bookstore. And that's all I have, and I would love to take some questions.
Yep, we do have some questions for you. We had a listener ask, how you got started in doing projects in other cities. And I think that's a great question because, a lot of times we hear people talk about, if you can't drive by it or, walk by it every single day, to be very cautious. So how did you get started in other cities and how do you manage it from this distance?
Absolutely. So there are a lot of people out there that will tell you that it's easy to invest in other cities and there are all these tricks to doing it. But I'm going to be honest, I invest in several cities and it's very, very difficult. And what I typically tell people is don't pick a city to invest in, another city to invest in, unless you either have family or friends or are willing to go to that city for a few weeks or a month or two and actually build a team that you trust. The hardest part in this business is to avoid getting taken advantage of by agents, by inspectors, by contractors, by anybody in the business. And to do that, you really have to have people on the ground that you trust implicitly. And so what I would tell somebody is I've never gone to a market where I didn't have at least one person in that market that I was willing to hand my checkbook to and say, you can sign checks for me. If you don't have at least one person in that market that you're willing to give full access to your bank account, you probably shouldn't be working in that market, because what you're going to find is you're going to spend more time and effort and headache investing in that market than just working really hard and trying to find deals that are closer to home. So it's definitely possible to invest in other markets, but start with somebody you trust or spend some time in that market building relationships and finding somebody that you trust. Okay. And don't expect that if you're going out to another market that you're going to be able to set it and forget it. That doesn't happen. If you're investing in another market, especially if you're doing flips, expect you're going to be traveling to that market once every month or two, maybe even more often. If you're doing buy and hold real estate, expect that you're either going to have a property manager that you trust implicitly, or you're going to be flying out to that property at least once or twice a year to deal with tenant issues and do inspections and deal with tenant turnover. So it's difficult to invest in other markets. The big thing that I would tell people is, for the most part, the biggest reason I hear people wanting to invest in other markets is because they think that their market doesn't have any deals and every other market does have deals. That's not the case. Most likely, if you can't find deals in your own market, you're probably going to have trouble finding deals in other markets as well. So I would suggest work hard on learning how to find deals, focus on your own market, and you'll probably find that your market is just as good as any other market. It just doesn't seem that way when you're in the midst of it.
And I just want to add a little bit to that because I was at a meeting last night where, one investor newer to investing was talking about how it's harder to find deals now. Maybe that has something to do with a little bit of a change in the economy or, a change towards the end of the year at least. And, another investor, a seasoned investor said, I'm getting calls of, 15 deals a week that I'm analyzing. So I just want to point out, as Jay mentioned, building your network, this newer investor maybe doesn't have as big of a network as the seasoned investor does. And so that's going to be important too. So make sure that you're networking in your local area and, lean on those people who are seasoned because they're going to help you understand how to find those deals. And, maybe you can work together on a deal and really sort of get experience on that. I also want to mention that I have just one more question pop up here. So if you do have a question for Jay, go ahead and get it typed in now so we can make sure we get it answered. But Jay, we have an investor that is buy and hold, mostly of single family houses, but they're moving into multifamily. And he wants to know, should I be more reluctant to move in that direction?
Okay, so let me answer this question in a couple ways. First, should you be more reluctant? Absolutely not. I'm actually a fan of multifamily right now. A year ago, I might have said that or a year ago, I was more cautious about multifamily because I thought there was a good chance that we'd see interest rates start to rise. I thought there was a good chance with interest rates rising, typically cap rates or returns start to go down. So cap rates go up, which means returns go down. So I was a little concerned about a year ago that interest rates were going to move in the opposite direction from where they moved and that returns would drop. But now that we're seeing interest rates go down and there's essentially zero chance of interest rates going up anytime in the near future, I'd say that multifamily is still a good investment. I buy a lot of multifamily these days. That said, multifamily is getting very difficult to purchase these days. So I've been looking in several cities around the country. I've been looking for some large multifamily, and what I'm finding is there's a whole lot of competition for it. Especially the very large, like the 100, 200, 300 unit plus complexes. There's a whole lot of competition. And the only way to get access to decent deals in those markets is to really spend a whole lot of time building relationships with brokers, because brokers are coming across decent deals every once in a while, but they're taking those deals to the investors that they know well, the investors that they've worked with before, and it's making it difficult for smaller investors like you and me, presumably, to get access to these big deals. Now, there's this middle ground. There are these mid-sized properties, what I like to think of kind of in the 10 to 50 or 10 to 60 range units. I'm still a big fan of those, especially in the smaller markets. So if you go into any of the primary or secondary markets, the big cities or the suburbs, these are harder to find. But if you go into what are called the tertiary markets, those markets that have under 30,000 population, these 10 to 60 unit deals can actually be very lucrative. And we've bought a number of those over the last couple of years. And I really like those deals. I will warn you, the tough part of 10 to 60 unit deals is going to be the management. Typically these units or these buildings aren't large enough. They're too large to have basically a single person managing them, but they're not large enough to have an on-site manager. So typically you need a hybrid management structure where you kind of have somebody part-time devoted to managing your project, or you have a couple people that are working part-time. So management of these types of multifamilies is difficult, but I would recommend anybody that's looking to buy or get into multifamily right now, look at the 10 to 60 unit complexes, because anything bigger is going to be really, really hard to break into right now. And anything smaller, it's really hard to find deals right now.
Okay, that was amazing, Jay. I really appreciate it. I didn't have any other questions pop up, just a comment. I had an attendee that would like you to come back and do another webinar with us, so we'd love to have you back.
Would
I
love
want
to.
to thank you again. And I think it was all really good information. I want people to, really take this into consideration as Jay mentioned, not that you should stop doing deals, just maybe look at them more conservatively. And if you have any questions for me or for Jay, please just email me. We'll get your questions answered. The recording is going to be available, so if you want to hear it again, if you want to sort of study the information that Jay provided, you are welcome to. It'll be up on our YouTube channel probably on Monday, and also we will send out the recording to those that registered. So thank you so much, Jay.
Absolutely. Thank you, Larissa.
Take care.